Welcome to Day 21 of Future Business School's Daily MBA series. Today, we're going to explore one of the most important topics in corporate finance: investment appraisal. This is the process companies use to assess the profitability and viability of an investment. The key methods we'll cover are net present value, internal rate of return, and the payback period. These methods are essential for making informed financial decisions, whether you're expanding operations, launching a new product, or acquiring another company. Let's break them down. What is investment appraisal? Investment appraisal, also known as capital budgeting, is the process of evaluating potential investments or projects to determine their profitability and risk. The goal is to decide whether the investment will generate enough returns to justify the initial capital outlay. Investment appraisal is crucial because it helps companies allocate resources efficiently, assesses the risk and return of different projects, and ensures that investments align with the company's long-term strategy. Now, let's look at the three most commonly used methods to evaluate investments: NPV, IRR, and payback period. Step 1. Net present value, or NPV. NPV is one of the most widely used methods of investment appraisal. It calculates the present value of all future cash flows generated by a project, discounted at the company's cost of capital, minus the initial investment. Formula: NPV equals the sum of CF/T divided by 1 plus R raised to the power of T minus initial investment, where CF/T is the cash flow at time T, R is the discount rate, often the company's WAC, and T is the time period. If the NPV is positive, the project is expected to generate more value than its cost, and the company should invest. If the NPV is negative, the project will destroy value and the company should reject it. Example: let's say you're considering investing $100,000 in a new project. The project is expected to generate $30,000 in cash flow each year for 5 years. If the company's required rate of return is 8%, you would calculate the NPV as follows. NPV equals 30,000 divided by 1 plus 0.08 raised to the power of 1 plus 30,000 divided by 1 plus 0.08 raised to the power of 2 plus 30,000 divided by 1 plus 0.08 raised to the power of 5 minus 100,000. In this case, if the NPV is positive, the company should proceed with the investment. Advantages of NPV. It takes into account the time value of money. $1 today is worth more than $1 tomorrow. It provides a clear figure for value creation or destruction. Real-world example: Microsoft. When Microsoft invests in new software development projects, it uses NPV to determine whether the future cash flows from selling the software will exceed the initial R&D costs. If the NPV is positive, they proceed. If not, they reconsider the investment. Step 2. Internal rate of return, or IRR. The internal rate of return is another popular method. It's the discount rate at which the net present value, or NPV, of a project is zero, meaning the project breaks even in terms of time-adjusted cash flows. The IRR represents the project's expected rate of return, and it's compared to the company's required rate of return or cost of capital. While there's no straightforward formula for IRR like NPV, the concept is simple. IRR is the discount rate that makes the following true. NPV equals 0. To solve for IRR, you set the NPV equation to 0 and calculate the discount rate that satisfies the equation. Many financial calculators and software like Excel have built-in functions to compute IRR. If IRR is greater than the required rate of return, accept the project. If IRR is less than the required rate of return, reject the project. Suppose you have the same $100,000 investment with projected cash flows of $30,000 per year for 5 years. You calculate that the IRR is 10%. If the company's required rate of return is 8%, The project is worthwhile because the IRR exceeds the required rate. Advantages of IRR include providing a rate of return, which is easy to compare with other investments, and considering the time value of money. However, it can be misleading for projects with non-standard cash flows, meaning cash flows that switch between positive and negative, and it assumes all intermediate cash flows are reinvested at the IRR, which may not be realistic. For a real-world example, Tesla often uses IRR to evaluate investments in new factories and production facilities. For instance, when deciding to build a gigafactory in Nevada, Tesla would have used IRR to ensure the project's returns met their expectations relative to the capital invested. Step 3. Payback period. The payback period is a simpler method that calculates how long it will take for an investment to pay back its initial cost from the cash flows it generates. It's a straightforward measure of risk because it shows how quickly a company can recover its investment. The formula is payback period equals initial investment divided by annual cash flow. This works well when cash flows are consistent over time, but if they fluctuate, the payback period is calculated by adding cash flows cumulatively until the initial investment is recovered. For example, if you invest $100,000 in a project that generates $30,000 per year in cash flows, the payback period is 3.33 years. This means it will take just over 3 years to recoup the investment. Advantages of the payback period include being simple to calculate and understand and providing a basic measure of liquidity and risk, showing how quickly the money is recovered. However, it ignores the time value of money, treating future cash flows equally to today's, and it ignores cash flows that occur after the payback period. Retail chains like Walmart use the payback period to evaluate new store openings. They want to know how quickly the store will generate enough profit to cover the costs of building and opening it. Shorter payback periods are preferred in industries where market conditions can change rapidly. Case study: NPV versus IRR in practice. ExxonMobil. When ExxonMobil evaluates new oil exploration projects, it uses both NPV and IRR to make investment decisions. For example, when deciding whether to drill in a new location, they calculate the NPV based on expected future oil prices and production costs. If the NPV is positive, they move forward. They also calculate the IRR to compare the project's return against other potential investments. ExxonMobil might choose a project with a lower NPV but higher IRR if it's looking for quicker returns, depending on market conditions and other investment opportunities. Conclusion and key takeaways. Investment appraisal is critical for making informed business decisions. The three primary methods, NPV, IRR, and payback period, each have their strengths and weaknesses, but when used together, they provide a comprehensive view of the potential value and risk of an investment. Key takeaways. NPV tells you how much value a project will add or subtract, considering the time value of money. IRR gives you the rate of return expected from the project, which can be compared to the required rate of return. Payback period helps measure how quickly you'll recover your investment, though it ignores cash flows beyond the payback point. Thanks for tuning in to today's episode on Investment Appraisal. Be sure to like, share, and subscribe to Future Business School for more content. In our next video, we'll discuss risk management and hedging. Stay tuned.